Last week, I stumbled upon 3 separate research reports that, when viewed together, reveal something critical about Amazon's evolving marketplace strategy. While each report was interesting on its own, the real insights emerged when I overlaid the data sets. As we are well into March of 2025, it's clear that Amazon is executing a market position, strengthening on 3 fronts simultaneously. 1, expanding their private label offerings. 2, allowing third-party sellers to absorb pricing pressure. And 3, extracting more value from brand partners through tougher vendor negotiations. Let me break down this triple squeeze and what it means for established consumer brands navigating the Amazon ecosystem. Good morning and welcome to the Retail Media Breakfast Club. I'm your host, Kiri Masters, and every weekday at 6 a.m. Eastern, I bring you candid and real discussions in the world of retail media and marketplaces in just 10 minutes. So bring your own cup of coffee and we'll get smarter about retail media together. Let's start with the first force. Amazon Basics, Amazon's private label brand, is thriving, not retreating. Now, there was a lot of noise not so long ago about Amazon Basics and many Amazon private label brands, everything from apparel to home goods. Obviously, there is a really strong Basics brand around things like batteries and other consumer goods. And then it receded quite a bit, especially during the antitrust hearings from 2020, 2021, around that era. And this was a point of contention amongst third-party sellers that Amazon seems to be using our sales data and insights to build their own product ecosystem and cutting us out. And there was some pretty scarily similar product launches that Amazon made that seemed to be pretty direct ripoffs of, especially, these smaller independent brands. And that got a lot of media attention. So it seemed for a while that they were really scaling back on private label because the juice may have not been worth the squeeze. But Martin Hubel from the consulting firm Consultus popped up with some interesting data that he sourced from a tool called Smart Scout. And he found that Amazon Basics remains a powerhouse with 4,300 products across more than 20 categories. And what he found in terms of the GMV from this brand alone was pretty staggering. Amazon Basics generates roughly $180 million monthly from US customers, and then another $35 million from European markets. And so when we add it all up, we're talking about a global business worth $2.7 billion annually. These products are in different categories, but particularly strong in health, household, office, home, kitchen, and pet supplies. So that's force number 1. Amazon Basics never really went away. Amazon just allowed it to fly under the radar a little bit more. The second force at play here involves third-party sellers facing what I'd call a pricing paradox. So again, this data comes from Smart Scout, and it comes from a report that has just been released, actually, the Voice of the Seller research that came out just this week. And this research shows that about 2/3 of Amazon sellers raised their prices last year, mainly because of rising fulfillment costs passed on by Amazon. But here's the kicker. Nearly 60% of those who increased prices still felt less profitable after doing so. This is all happening in an environment of intense competition. Almost half of the brands surveyed in this research pointed to competition as their biggest obstacle to success on Amazon. International sellers are a particular concern, with half of all respondents seeing overseas competition as a risk to their business. And even the larger sellers in this research, those doing over $5 million in revenue, share this same worry. And so we're seeing what is about 1/3 of these sellers described as a downward spiral, where the international competition pushes prices down while the rising FBA fees force prices up, creating an unsustainable squeeze on margins. And now for the third force in this trifecta, and that is tougher vendor negotiations for brands. Look, Amazon vendor negotiations, or AVNs, are always challenging. Amazon's always asking for more, and this year is no different. Industry analyst Stratably and Consultus teamed up to put some research together showing increasing pressure. 17% more brands are finding this year's negotiations harder than last year's, while over half expect an increase in trade terms. Perhaps most concerning, 40% of vendors are facing potential punitive measures. So as I said, AVNs are always tough. The usual result is higher co-op fees, marketing fund requirements, not passing on cost increases to Amazon, and stricter supply chain compliance. But what should be on more brands' radars is that private label offering piece, and to what extent Amazon is negotiating with you while also building a competing product. Now, when these three trends converge, we see a market dynamic increasingly tilted in Amazon's favor. Both third-party sellers and first-party brands face margin pressure, while Amazon continues to expand its private label portfolio. But there is a counterpoint worth noting. In that vendor study, about 3/4 of Amazon vendors report that their Amazon margins are meeting or even exceeding their internal goals, compared to just over 1/4 reporting unhealthy margins. And that suggests that while the ecosystem is challenging, brands with the right strategies in place can still achieve profitability. So there's a few strategic implications here for larger consumer brands, as in those with revenues over 500 million. I see three approaches. First, in the vendor negotiations, negotiating from a position of strength. Larger brands typically have more leverage than smaller sellers, and Amazon customers expect to find major brands on the platform, and their absence is going to impact the Amazon customer experience. And so when entering negotiations, coming prepared with robust cost justifications and a clear plan for driving volume growth, because Amazon really needs you on this platform as well. The second is differentiating to avoid the Amazon Basics trap. If you're in a category where Amazon Basics products are thriving, they're generally commodity-like categories, larger brands really need to be leaning into R&D, unique packaging, or unique brand messaging to avoid falling into that commodity trap. And finally, investing in brand building beyond Amazon. Amazon's obviously a critical sales channel, but established brands need to build consumer relationships that transcend the marketplace. Both from the Smart Scout research and the AVNs, it's clear some brands are doing really well. Typically, it's these smaller sellers that are really feeling the pinch. So the brands that can focus on meaningful product differentiation, operational excellence, and strategic negotiation approaches can maintain healthy Amazon profitability and protect their market position from private label encroachment. Well, that is it for today. I hope you enjoyed this episode of the Retail Media Breakfast Club. We meet here every day at 6 a.m. Eastern. So be sure to subscribe and get your daily dose of insights, trends, and hot takes in the world of retail media and marketplaces.